Oops. Okay, cancel this really quick. Shit. Oh my God. All right. I'm going to have to probably clip this one a little bit because I'm hitting the wrong button. This is Markets with May, and we are going to do Carvana this afternoon. I owe this to a few people that have been following my stream specifically for Carvana. Sorry, I'm a little bit delayed on this, but I want to go through the good, the bad, and the ugly of the quarter. Okay, let's get into it. I don't have a position on Carvana right now. Past performance not indicative of future returns is what I think the SEC wants all social media folks to say. And let's kind of go through it. Today, I'm actually going to be doing a couple of different live casts so that they can be cataloged correctly by YouTube, that they do their stuff. And Carvana I'll do, and then a bit later I will also do Credit Suisse. So if you want to start seeing everything, definitely hit livecast. I have a conversation I'm probably going to do with YouTube at some point just to find out why it's not as easily searchable, because I've gotten some feedback from a few of you in the last weeks that you've had difficulty with it. But Carvana, let me stop sharing for just a second. The thing that you should know with Carvana, they're obviously attacked by the short sellers on the regular. And in fairness, I have gone both long and short Carvana for various reasons. It is such an innovative company. And truth be known, I kind of want to root for the management team because they're such scrappers. And you'll see from a past video that I did, it's a bit of a saga. You know, the CEO is the child of a guy that is hella rich, for lack of a better way to call it. I mean, and it's always been the case that people have been thinking or concerned or curious as to whether or not he'll just get the funding and money from his dad. And I think in the last episode, everybody was saying he needs like 150 million. And I was like, no, look at this cash flow statement. He probably needs closer to 2 to really have that buffer. But on the one hand, I still think that if he could get infusion of capital, life would be really great. But I want to show you kind of the good, the bad, and the ugly off of what I saw in the income statement. And they're really, I'm going to actually do it backwards. So we're going to start with the ugly, which was the quarter, the bad, and then work our way towards the good. All right, let me share my screen here for a second. Okay, and I gotta move these. I have to figure out how to like improve the way that this shows because it's so hard to see. So this is just straight from their most recent earnings report, and you can see the way the numbers fall out. Is revenues down about 25%, gross profit, ouch, down 62%. And they show their numbers a little bit differently. I'm sure once they hit the SEC with their filing, it'll look like everybody else in the way that they show their numbers. There's nothing wrong with showing it in a variety of different ways. But the net income, and it's kind of important to understand the SG&A when they're doing, they say a few different things, but SG&A, when they're talking about it, is not included in a way that I would ideal is how I'm going to say it. Here are the relevant charts from their earnings release. They show that gross profit per unit, they show the decline year over year, but you also want to read very carefully that really it's not this 3,000 number. On a GAAP basis, it's $2,200 per car is what on non-GAAP, which I'm comfortable giving it to them, it's $2,600 approximately dollars there. And that's a really thin margin for a used car, given that Carvana, similar to CarMax, really only sells cars that are from, of the 7 years of depreciation. So it would be like 2017, I think you can still buy cars. There may be some that are as far back as 2009, but the bulk of cars are really 2017 forward. Net income loss, you can see, is pretty dramatic. And why are we caring about EBITDA? We care about EBITDA because what we're trying to do is get some cash flow concept here. And they just didn't give us free cash flow, so we care about EBITDA as a result. It's really as simple as that. And that's not looking great, but it has it this entire time because they are a 10-year-old startup that, in my opinion, in fairness to the shorts, again, like I said, I have a neutral position on this. I've been both long and short at different times, but this is really just informational this time because I find them so fascinating. Okay, but the thing is, they really came to market early. Okay. It used to be back in the day, you would come to market once you're already a profitable company. And the reason you'd be trying to capitalize yourself is something very specific, et cetera, et cetera, et cetera. But then the rallying portion of the 2000 period, which drove private equity to bring all these companies public way sooner. I mean, it's been that way for a while in private equity. I don't love it, but it kind of is what it is. Again, though, this isn't a profitable company and hasn't been for the most part. All right, going to the next slide. This is what actually bothers me a lot. Okay. And I have been talking about this in literally every company that deals with autos. Okay. Upstart, 50% of their book approximately is subprime, is auto lending, of which I think a huge component of that is subprime, but they don't really give you the correct mix on the numbers. So it's impossible to know the answer to that. This is Carvana. Carvana has its lending, and you can see it from the board composition. They have one guy on the board that specifically lends autos. And so because we always look for what's going on there in auto lending, because that's where all the car companies and also the lenders get in trouble, is that first gleam of subprime. We kind of want to watch this because this was not the case. In fact, they were doing better than a lot of other companies as relates to this. But then I saw it finally for the first time in this quarter, and that's originations of finance receivables being higher than proceeds from the sale of receivables. And what means is that they sold the cars, but they weren't able to get the loans quite off balance sheet. And some people sometimes there's a little bit of a remainder. This isn't a little bit of a remainder. This is $1 billion. Okay. And so when we look at it, it's $1 billion in loans. If you go back sequentially, you'll see that that was not the case in previous quarters. And then you've got to adjust. Again, let me kind of make this modification here so you can see it. You've got to adjust your operating cash flow number for that so that you can understand what's actually happening with the core part of the business, even above and beyond the piece that's lending, which is not what they do. They are not an auto lender, so they should not be holding loans on the balance sheet. And we know that this is also indicative of what we saw on Upstart. We've seen it in a couple of other places. Some people have asked me, May, what is it that you think about the lending in general? So I will go through that a little bit further. There's a couple more slides just to get through what they presented, but you can see on the balance sheet, you have about 1.3 billion up from 356 million, which is a more normal number that we've seen historically for this company. Extra billion is in assets, current assets. Realize that then if you're worried that they're not going to be able to offload that, you're going to have to remove that working capital calculation. What does that mean for people that are still coming up the curve? Working capital, current assets minus current liabilities, is their ability to pay off their current liabilities. Meaning, like, it's a little bit like when you're at home and maybe you've got a mortgage that's got this big balance, but what you're really trying to do is make enough money from work and the various investments that you have so that you can pay your daily food needs, et cetera, but also pay off that mortgage payment that you have, your car payments, et cetera. Working capital is that calculation. However, because this gigantic thing sits in current assets, you also kind of have to think, well, the dependency of that 1.3 is whether or not someone will buy those loans off balance sheet. And I'm telling you right now, that's not a given in this particular market. We will go through that a little bit more in just a second. Now, vehicle inventory down 40%. That's actually, to me, a good thing because that plays into a dynamic that we've been talking about since last quarter, which is just that all of the autos companies, a little bit concerned about what's going on with credit quality, have just been pushing the market for autos down. Okay, so we are going to go through that as well. Don't worry, but just realize the inventory drawdown of 40% is to raise cash so that they can pay off short-term liabilities, current liabilities right here. That's the same thing as if you're basically worried about being able to pay bills. So you start selling stuff out of your garage or out of your attic that can just raise a little cash and give you some buffer. And that's really what this is it's going to be, this story is so interesting because it's going to come down to the wire that way. Can he pay the debt or can he not pay the debt? And essentially, if you take out the debt portion, you do still have working capital that is positive 668. Okay, so where does that put us then? That means that if he's going to continue selling these used cars, we need to make sure that it covers that 668. Same thing as if you were doing your own personal budgeting. And also, we need to figure out what's going on as relates to that $1.3 billion that's locked up in those receivables. And there's some things to talk about there. And then just in general, what's the macro going on with these used cars? Let me review that because different people are in this company in a different way. Let me show you a couple of things, and then I will absolutely scroll through and take some questions. Okay, so here's what he was talking about. We saw like it's approximately 40% if you do the math there, and you can see approximately 40% here on vehicle inventory down. The difference between this 37, that 40 is the reduction of prices. So he got a little bit less margin. We all know that was going to happen. These are the things that say that he's focusing on in the future, which is break even, positive EBITDA. So we are really aware at Carvana that we have to try to get to profitability versus just spend money to grow the business. Okay, there is no way that you can think about this company without starting to think about inflation and the economic data at this point. This is what CPI and the PC indicators are, the two major indicators for inflation. PCE came out higher than expected, as did CPI, quite frankly. And the markets kind of did this nasty turn on Friday. And we'll see, because we're about to go into the dead period, what's up. I also owe all of you guys my update because I'm very close to finishing off the 400 calls that I listened to in the S&P 500. I'll probably be done call it middle of next week. So, and I'll listen to 400 at that point, but it's coming in about 50-50, and it all has to do with company strategy, but it's not nearly as bad as I would have anticipated originally going into the quarter. However, when you look at CPI versus PCE, if your focus is on cars, it's really going to be CPI. And also the breakout on data on CPI is pretty freaking stellar to give the Bureau of Labor, the Bureau of, I think it's Labor Economic Statistics or something, the BL, anyways, whatever. They do a great job on doing on CPI data. So I'm going to show you the breakout that comes from what they posted. And again, I'm gonna have to move it over. This is the line by line item, and they even do more than this in the various spreadsheets. I absolutely go through it, but I'm just going to show you the abbreviated stuff here because this is already abbreviated, so you can see it from the first spreadsheet. New cars, vehicles, sales are the price, the inflation is still coming up. So for a new car, the prices are still increasing, not decreasing. For a used car, you can see clear as day, it's down 11% at this point year over year. And even in December, you saw a very aggressive down 1.6%. The other thing that's really important is vehicle maintenance and repair and vehicle insurance. Those numbers have gone up. And there's a lot of different ways to look at this, but essentially, CarMax, Carvana had already reported that they were going to have to liquidate. And you can kind of see that if you just look at working capital between the two, that both of them were going to need to just sell cars, decrease inventory on a slowdown in consumer spending in general. Okay. However, we are not seeing the same thing in new cars, and particularly we're not seeing the same thing in cars that can decrease your average gas price per month. That's why you're seeing something very different in Tesla than you are GM and Ford. I'm just going to say it like it is. You guys hate me if you want. Now, the second thing that I want you to kind of understand, because that's the ugly is what's going on with used car prices. Also, if you care about this a lot, listen to my Upstart call, because there I talk on what it means on the financing side of used cars, which is going to be equally as important. Now, here's the truly ugly, as this was announced on February 25th, subprime auto lender American Car Center shuts its business. I talked about this. Here's the weird thing is that we are not seeing a decline in consumer credit quality, but we are seeing a lack of buyers of the debt and a lack of desire to fund auto debt. That was said by every single bank that I reported on in January. And I am going to do in this next coming time the same sort of deep dive into the regional banks and the investment banks that buy this sort of debt. Okay. Because what happens is an originator will originate the loan, and then they package it up across all the different stuff to dealerships, and then they sell it to an investor. And they could sell it directly to an investment bank type investor that has a loan book. They can sell it to a bank who maybe wants to keep that as a mix of loans, or they can sell it to, the debt proper investors like debt hedge funds, debt asset managers, stuff like that. But right now, because interest rates are so high, no one wants that debt unless they're going to get a return above and beyond everything else. That's why this company closed down. There may be other things going on, but given what I saw in Upstart, given what we're now seeing in Carvana and we're seeing in CarMax, that's the story of what's happening. It's ugly and it's kind of sad in a lot of ways, because in the past, when the auto lenders have taken it on the chin, it's been because the economy was bad and people couldn't pay their car loans. This time it's going to be because they can't legitimately get any more money. So they're just going to be running an operating loss or taking in a massive book of loans. Okay. So that's what's happening there. And it is ugly. And it is a function of the fact that right now, any kind of fixed income investor, be it a pension fund, which usually funds about 60% of its assets, 50%, or an insurance company or a bank, none of them want to take this type of risk, because just taking the boring stuff gives them a pretty nice return. That's what's happening here. Okay. Let's talk about the good as to why you can't be like, I just hate Carvana and all these companies, they're all going down to zero. Is the thing that you have to know that is the long-term story if they can survive. And this is from the Fed, which is basically Federal Return, the Federal Reserve, the U.S. of Economic Analysis in the St. Louis Fed organization. But here's the citation down below. This is what's been happening to domestic auto inventories for a very long time. This chart goes all the way back to 1994. They publish this number once a month, so it's always fresh, okay? This chart is legit. Auto inventories are low. And part of the reason that's happening is because of a whole series of nasty that happened in the auto industry from 2008 forward. But also what's being exacerbated in this particular moment is the fact that, look at CPI, we'll go back to CPI just to show it, is this: maintenance repair costs are so low. Now, you might be still trying to think through, like, why does that matter for vehicle inventories? That's because when maintenance and repair is extremely expensive, then insurance companies, when you damage your car, your used car, have the option to just pay you out a number that will not cover getting it fixed. And so some people will just give you a payout. Your car goes to the junkyard for parts, and that's the end of it. So we definitely see that in the numbers that the Fed has been putting out on domestic auto inventories as well. And the thing is, because of what's been happening post-COVID, we also don't have this crazy uptick in auto production. So we are absolutely at a low point. It's just whether or not Carvana and the bigger player can have a profitable business. Now, the last thing, I don't think I put a slide here, but it's important to note that, let me give you also world production, okay? It is not the case that world production or that the U.S. is somehow able to get by with imports of cars, because we don't import Chinese cars. Let's just call it what it is, okay? China is the only country that has been making cars like gangbusters, but that is for mostly domestic and also the greater China region. That's where they export to. They don't need to necessarily export much farther than that. They do have some cars that they sell in Europe, Middle East, and Africa, but those cars don't come to the United States. So as relates to something like Carvana, CarMax, it's not going to be relevant to us on that. And then the last thing I'm going to say, and then I'm going to take questions, is that as relates to the story really here is if they can survive. And it's not an insignificant story, but they're going to have to, I would say it's probably a 2 to 3/4 story at a minimum. And a lot of it is going to have to do with what's going on as relates to let me share this. I feel so bad, Hadouken. I don't always share the chats, but hopefully people can see it if they're just watching the YouTube on here. But so a lot of it will depend on whether they can survive and whether or not they can manage that funding component, which is going to be the debt side. And it's going to be really tough, because I think if you see multiple subprime auto lenders go bust, then what happens is the debt component then gets sold at a massive discount. What do I mean by that? subprime auto in particular oftentimes gets charged at 15% APR, annual rates, or it can even go significantly higher than that. And as it's going significantly higher than that, there's this thing called usury laws. So there's a cap, but in some states it's as high as 30%. So that's just off the interest rate component. But when you have a company go bust like that, they'll try to sell off the loans, and the debt, the debt hedge funds and the debt like traders, they're going to go in there and try to bid even lower than the principal. So they'll try to make money both off the interest rate and the principal. And while they're doing that, because it's giving them such a high return, they're not going to be buying loans off of companies that are trying to lend and sell cars right now. So that's what you have to get through. Things that could potentially help them is a cessation to the increase in interest rates, which isn't great because we keep seeing these inflation data come in a little bit more aggressively. Okay, let's see. Hadouken, I'm going to just show these really quick. These are really great. Thank you for doing that. I really probably should keep that on, but I just haven't. Cost of money is too high. Okay. Yeah, I was wondering why an Antara type wouldn't swoop in and try to capitalize on this. Yeah, it really has to do with the fact that it's a good question. I know a lot of you guys are all about AMC. I might have to do separate videos because of the way I'm trying to help the YouTube algorithm find the videos that I'm doing. But yes, you're right. That is exactly the type of fund that I'm talking about that would come in, and they're going to wait and probably see in the rubble of it, because they're like, even if they were to call me up and I want to see these companies succeed, because I am at the heart of it an investor that really loves to watch good management teams try to succeed. But even if they were to call me up, hey May, should I look at subprime auto right now? I'd be like, you should definitely make your relationships, but just give it a half a beat, because subprime auto could absolutely trade in this ridiculous way. I'm a huge fan of Tesla too, because like I said, this is specific in so many ways, guys. This is very specific to the used car guys. And it's specific to the used car guys because you are still seeing increase in new car sales, which is how Tesla makes its money. It does not sell used cars, although it does have a little tiny baby portion that you might call leasing stuff that gets sold. But it's the reason, like I said, it's because fixing your car is such a problem, that new car sales continue to do well at the expense of used cars. And also then you have what's going on in interest rates. Now, again, the beauty of Tesla is they don't have a financing arm attached to them, and they have a ton of cash on the off chance that really they have to do that business. Most of that business is outsourced to Bank of America. And then if you're not able to do that, then you have to find a different lender, of which there are people that lend. I would also mention with Tesla that the depreciation on that car isn't as aggressive as it is on other cars. It just is what it is. That said, we're going to all have to watch it really closely with Tesla. They've got their investor day that comes out. My suspicion is that on the investor day, you are going to see them talking about the one thing that I'd be really excited to see, which is how they're going to improve their operating expenses. They have been talking about different ways that they were going to streamline manufacturing. The fact is they make more than any other auto manufacturer on these cars as relates to margin. Okay. They make a better gross margin because, quite frankly, they have a better production approach. And I know there's people that are going to hate me, but that is what it is. But yeah, great. I'm so glad, because sometimes I say things and it may not clarify clearly. But the financing arm, what it does is it essentially acts for GM, Ford, and all the other auto guys. It acts as a subsidy to selling of cars. So you are actually taking on both credit risk, and you are in something that should just be selling cars for a living. And so with GM and Ford, that 100% happens. And they typically have not had a problem, except in 2008. They ate it like everybody else, because the subprime auto piece closes down. And what happens is that the prime auto still continues a little bit if you've got some banks that just were never touching it. But then you have other buyers that are just going to be like, whoa, subprime just defaulted. I should give it a half a beat and see if I can get everything on the cheap. And so that's why we watch it very closely no matter what. I don't know what you're saying, Belle Biv DeVoe. I think that might be out of context. Okay, let me see what else we've got here. If there are any questions, Kim, shout out. Hey, hey, hey! Right back to you. Thank you so much for watching my stuff. I am not from the Bay Area, Dave Bigo. Thank you for coming by. Carl, thank you so much for your support. Appreciate you. I just want to do some shout outs here. I'm in New York City, Dave Bigo. And yeah, this is the guy. Okay, thank you, Hadouken, because I usually have that memorized, but for some reason, I went to a birthday party last night, and so you can even hear it in my voice. I was really excited to celebrate my friend Sunny's birthday. He's turning 41. Woohoo! Maybe I shouldn't have given out his age. Anyways, Ernest Garcia, he's the co-founder. You got to look up this guy because it honestly, if you really do more work on this particular company, it reads like a show that I used to watch in the 80s called Dallas and also Dynasty. Dynasty's is now on Netflix as well, but it really reads like these really wealthy families where the kid is a business guy that's just trying to not depend on his father to try to like make it happen. And part of me really like feels for that in a big way. Like he basically spun this portion of the business out of his father. So his father, Ernest Garcia, is the second is on the Forbes 500 list and did some crazy time during the defaults in the 80s on I think it was a mortgage crisis. It was more of a mortgage crisis back then, but he was a mortgage lender. But seriously, if it's just an interesting thing for you guys, research this company. I have a video which I'll tag later to the show notes of the original video that I did. But it is just really, really a cool story. Duke and I don't watch fantasy. I did watch Fantasy Island. I loved Tattoo as a kid. You know, it was really fun. All right, guys. Okay, I'm going to say something really quick because I haven't actually done any videos on AutoZone and O'Reilly, though I do watch them. And there's a few. And this is really kind of an interesting, I have to really think about it. But at first, yes, they were doing really well. And on the service side of the business, most auto service folks are doing great. And especially the professional business is doing quite good because, I mean, like, look, I live in New York, so I don't even have a car, but I do know that when my dad and I were talking about some of the cars that sometimes we fix up, like, you know, he'll get me involved a little bit because my dad's awesome. I don't know another way to say it, but like, but you know, it is actually really hard right now to get a time slot to fix your car. So that is a truth. Now, I would say that, so you guys are posting really funny things. I would say that the parts business suffered from supply chain issues, which hopefully are starting to alleviate. In particular, it is the case that a lot of this auto parts are made overseas actually in China, strangely enough. So we'll kind of see how that goes. Additionally, the auto parts business has benefited from the decline in steel and aluminum prices, also from a China reopening. So it's a real, but the nuance of all that's going to happen, I've not listened to the auto companies this quarter yet. I kind of want to listen to it a little bit and see. So I'll come back to you on that. And I don't see any more questions, but I hope you guys are having an awesome day. Sorry, Belle Biv, I don't know that song, but I appreciate you trying regardless, just to keep the comments fun. But I'm going to go ahead and shut this down. I will be probably doing a video later today on Credit Suisse, which is just a story that I think is so interesting as well. Credit Suisse is very binary. It'll either go back. I don't know that it'll go bankrupt, but it'll either go really, really down. But we'll talk about that further on that video, or it will like actually start trading like an actual bank should. But we'll go through the story of that next. And thank you guys for supporting me. Really appreciate you. Good luck this coming week. If